Welcome to the special presentation of the week, this week titled Trading ETFs for the Small Account. My name is Todd Shaffer, Manager of Research for VectorVest, and I'll be presenting for you this evening. Many of our subscribers are just getting started with investing or trading a small account. ETFs can offer them the benefits of diversification, which can help mitigate the risk of trading just a few positions. For more on those benefits, I offer you some additional resources, special presentations we've done historically. On May 19th of 2017, presentation titled Cherry Picking Contra ETFs. And while this presentation focused on Contra ETFs, it also includes information on what is an ETF, how do they work, and how do leverages work on ETFs. So some great information there. Also on October 7th of 2016, a presentation about position sizing and managing risk for your portfolio. So what are the challenges when trading a small account? When we talk about position sizing, Dr. DeLito's advocated that we want to diversify risk in our portfolio by building a dollar-weighted portfolio of 5 to 20 stocks. Risk is spread out over multiple positions, which means if we have just a few positions fall back, then it's not a big impact on the performance of the portfolio overall. But when we have a small portfolio, say in this example a $10,000 account, if I spread the portfolio across 10 positions, I only have $1,000 in each position. Well, if I'm paying a $10 commission, a $20 round trip, that's 2% of the trade. I'm working just to pay the broker. And so the temptation would be to trade fewer positions to increase the trade size. But that starts to tip the balance back toward risk in only having 5 positions, say, open in the portfolio, should one or two of those positions have a large adverse move. So enter ETFs. ETFs, like mutual funds, are designed to replicate the performance of a basket of stocks. And so ETFs typically have lower volatilities, and therefore a lower probability of a large adverse move. So using our example of our $10,000 account spread over 5 positions, we now have a $2,000 position size, meaning our $20 commission is only 1% of the trade. Of course, this puts a premium then on finding the lowest commissions you can find, and often ETFs have the benefit of lower trading commissions with many of the discount online brokers. With that in mind, let's talk about how ETFs perform and some ideas on how we might trade them most effectively, particularly for the small account. And I can think of no better place to start that conversation than Dr. DeLito's essay from January 26th of this year. Let's take a look. I've taken us into the program looking at the essay on the Views tab from January 26th. And the essay was titled that week, How to Turbocharge Your ETF Portfolios. He begins the essay with a little background. Although exchange-traded funds, ETFs, were introduced less than 25 years ago, they've become extremely popular. VectorVest 7 US tracks 1,522 ETFs, and we treat them the same as stocks to the degree possible. A major difference in our analysis of ETFs compared to common stocks is that we do not analyze ETFs for fundamentals. So value is set to equal price, and relative value, RV, and relative safety, RS, are set to equal 1. However, relative timing, RT, is computed in the standard fashion. This is very fortunate. RT is a fast, smart, short-term indicator of price trend, and it can see things you cannot see with the naked eye. It goes above 1 when the ETF's price is trending higher, and it goes below 1 when its price is trending lower. It can sense momentum changes in price and will diverge from the visible trend of price movements. This is a valuable and powerful feature of RT. He then did some testing of high RT ETFs and looked at their graphs, and he noted that although they performed well, when he looked at the graphs of the ETFs, they were pretty bumpy early in the year, but shot higher in the last 3 or 4 months. I like smooth rising price patterns, so I added CI to the mix and sorted by RT times CI descending. And he concludes, I believe that using RT times CI is how to turbocharge your ETF portfolios. And so the key here is when we're looking for our ETFs, the RT times CI sort will help us find those with those nice steady price graph patterns from bottom left to upper right. So where do we find them? Well, we begin on the Viewers tab in the VectorVest program. And we'll first notice in the Viewers section of the toolbar that there is an ETF viewer. And if I click on that, this will give me in stock viewer format all of the ETFs that currently exist in the database sorted by VST descending. As Dr. DeLito related in the essay, the RV and RS scores are both 1, so the driving indicator here is RT, and we see the sort in RT descending order. And it would appear since the essay in January, we now have 1,548 ETFs in the database. And if we look at some of their graphs, looking at a 1-year time frame in the default graph layout, we can see generally, as I just click through them, they are going bottom left to upper right. But some of them are bumpier than others, as Dr. DeLito experienced. But I'd have you also notice as we look at some of the company names here, this is a mashup of bull and bear ETFs, leveraged and non-leveraged ETFs. If I go to the sector viewer, all the ETFs are in their own sector. So by going to the ETF sector and double clicking, I'll now see all the ETF industries in that sector. And you can see the ETF industries are a little narrower than the broader market, than the broader stock market, with 32 industries identified for the sector. If we display all, we'll see that all of the contra or all the bear funds are in one ETF industry called short. Of course, each of these industries then, if I drill down by double clicking, I'll see the ETFs that are represented in that industry. But again, I have non-leveraged and leveraged ETFs, both 2x and 3x ETFs. Of course, when I add leverage, I'm adding volatility, and that's what I'm trying to avoid here with my small account. But I also might have a lot of duplication, overlap of different vendors offering an ETF that cover the same underlying. So to help us sort through the madness, our database team has created several watch lists for the ETF sector. Right at the top we see 2 times and 3 times leveraged, both regular and contra ETFs. A broad watch list of contra ETFs. As we scroll down, we see offerings from the different vendors. Some index ETFs. But as I scroll down, I come to the jumping off point for us today. Non-leveraged ETFs regular. This watch list has removed from the list of 1,500 ETFs. We're down to 994, and all of these are non-leveraged ETFs, which of course will have lower volatilities. We do still see that many of them, though, have unacceptably low average volumes, and we still have some overlap where we have a couple vendors offering ETFs covering the same underlying. So here's where the Unisearch tool can become a great help. Let's move to it now. In the Unisearch tool, we have a group called ETFs. In this search group, we have bullish and bearish ETF searches. Our first search, best performing ETFs C up. Let's click on it and look at the search parameters. We see first that it limits any stocks found and requires them to be in the ETF broad sector. It also says that any of those found cannot be sell rated. No contra ETFs, no bearish ETFs, and we have some price and volume limitations to make sure that we get some acceptable average volume levels. We filter for the exchanges, and we filter out also contra ETFs, another variation of our contra ETFs. And very importantly, what I like most, it already has that sort that Dr. DeLito liked of RT times CI. With some simple modifications, we can get this search to focus solely on the watch lists that we want to include. So I'll change our watch list filter. So this is stocks filtered by a watch list. And this time I want the watch list to equal, not the contras, but let's scroll down and find our non-leveraged ETFs regular. And click OK. Now any ETF that it brings back has to be a member of that watch list. So the stock sector is redundant. I'm going to delete that. I like the recommendation is not a sell. That means they can't be in a downtrend. The industry group is redundant, as is the stock exchange. So now we're going to find hold or buy rated ETFs that are priced at least over $1 and have at least 100,000 shares of average volume, and they're in the non-leveraged ETFs watch list. We're going to sort them RT times CI descending. Let's run the search. I'll close our toolbar. We see in the search results we now have our column that shows us the computation of RT times CI, and we're sorting descending. All of our prices are indeed above $1, and as I scroll to the right, and we're getting average volumes well into 6 figures. But I notice I still have some overlap, and if I scroll to the right, I see that I have several offerings from the same industry. And of course, with a 5 ETF portfolio, I'm interested in diversifying the industries. So I could cherry pick just the top performer from each new industry. And if I look at their graphs, I have indeed found a diversified list of ETFs that are going bottom left to upper right. I can also use the Portfolio Genius to help me automate this process. That will also allow me to use the backtester to see how this idea performs. So the first thing I have to do is save this modified search. So I come back to my icon, click Save, Save As. And you can see that I created a Strategy of the Week group. And I'll change the name of the search to Non-Leveraged ETFs. And click OK. And so you can see in that group, we have our non-leveraged ETF search. And I've also taken the liberty of creating a sister to it that looks for 2 times leveraged ETFs. So beginning with our non-leveraged search, let's move to the back tester. And let me show you some work that I've done that illustrates how ETFs trade a little differently from stocks. For my testing time frame, I chose a market period beginning in January of 2016 through current. And while the market rose through this time frame, we did have several significant pullbacks, including the one at the beginning of our test bed in January, but also the fall of 2016, and of course the correction we just went through here in February. So let's see how we did. For my initial run, I took our search and I ran it over that time frame, and here are the results. Let's review our setup. We'll click on the Edit button. And first, let's look at our account settings, where I changed our total investment to $10,000, representing our portfolio size. We're still paying just under $10 per trade, and we're going to execute our buy and sell orders at the next day's open. For our trading plan, I'm looking for, at this point, the native performance of this search. So I'm not going to have any money management rules yet. So we're going to run our non-leveraged ETF search with no stop criteria. But we are going to only trade 5 positions, automatically replacing those as long as we're still in the confirmed up call. with no limit to the amount of positions opened in a day. We're not going to close any positions when we go from a confirmed down call back to a confirmed up call. That'll become important later. We're going to invest the average portfolio value, buying odd lots, not repurchasing the stocks that we've already owned for one day. And here's where we have our diversification forced, where we can only buy one ETF for each industry. This keeps me from buying, say, 2 S&P 500 based ETFs. And we're going to limit the number of shares we buy to be less than 1% of the average volume. Of course, on the confirmed down call, we're going to go to cash. So how did that work? Well, we had a winning trade percentage of about 42%. We actually lost about 1% overall. We had about 69 trades in the 2-year window, and we had a maximum drawdown from peak to trough of 17.49%. Call it 17.5%. So this is just our base run, and the interesting things to note as we look at the equity curve is that in each of these equity curves, with the exception of our correction that we had in the fall of 2016, each of these equity curves performed well on the upswing. We built portfolio value. Where it fell apart was giving it back on the downside of the market turn. So let's see if we can improve that with some proper money management. The first change I made was to add our profit locker stop. So as we look at the settings here, we'll notice that I've now included the profit locker stop with the default 50-15 values for the target and stop percentages. You'll notice that I also found that I had a better overall gain by not closing on the confirmed down call anymore, but actually holding through the confirmed down calls, letting the positions fall out on stops. With that change, we improved our performance dramatically, where we now had 50% winners, an overall gain of 19%, which comes to an annualized rate of return of 8% per year, with commissions of only $228, which means we dropped the number of trades down to about 22. And our drawdown improved from 16% to 11%. Looking at the equity curve, I did notice that we still pulled back in the fall of 2016, and of course we still pulled back in the correction of this last February. Could we do better? Well, I kept working. After running a few more combinations, I was able to improve our performance. Let's take a look at the settings. We were still using the same search with the same stop criteria, but I changed our stops to end-of-day stops where they're only applied on the closing values of the stock. This helps eliminate trades that are based on intraday volatility and only closes the position if the close is below the stop loss. By stepping in at only one position on each day, I was able to slow down the replacement of stocks that helped limit some of the pullback that we saw in those two instances. Let's take a look. We now improved our winners to 58% with a 29% overall gain. Total commissions remaining low, just 20 trades, with an annualized rate of return of 13.63% and our drawdown of just 10.81%. Portfolio still pulled back with the market, but we mitigated some of that pullback. One other note that I find interesting. At the close of this portfolio backtest, we were holding 3 long positions in the portfolio. And that's because on the pullback in February, we've stopped out of those positions by using the profit locker stop. And of course, we've not yet had a confirmed up call to replace those stopped out positions. It's interesting to compare that to another run that I made, and this time using a 50 gain 10% stop loss, not trailing, just fixed stops. And on this approach, I was able to get a 35.86% gain, annualizing to a 16% annualized rate of return, but the drawdown a little steeper at 12.25. Notice the difference in the performance of the equity curve here on this portfolio, which is still holding 5 positions. So on the retracement, those stocks didn't fall to loss, a 10% loss, and so they remained in the portfolio, capturing the gain as we bounced off the low. Compare that to our profit locker stop. This stopped us out, and of course, since the positions were no longer there, they couldn't rebound with the market. And that represents a choice. On the market pullbacks, had the correction deepened, our profit locker stops would have protected us more from that pullback, as exhibited by the lower maximum drawdown. Now remember, because these are non-leveraged ETFs, their pullbacks are less dramatic, but so are their gains slower. So as a comparison, I use the same exercise on our second search using 2 times leveraged ETFs. All of our portfolio settings stayed the same, but I found with the 2 times leverage search, it worked better with the green light buyer. This makes sense as the double leverage stocks move faster, so they respond more favorably to the faster timing signal. And comparing this native performance to our non-leveraged group that was essentially flat, we see a much better equity curve here with our leveraged ETFs as they're able to accelerate faster in those rising markets. But it does come at a cost with a higher maximum drawdown. And so that leverage makes the swings bigger. So we accelerate to the upside, but we also accelerate to the downside. But overall, we were able to garner 65% winning trade percentage. We gained 67%, which annualized at 31%. Much more actively traded, with about 50 more trades in the time frame. And of course, as we said, our drawdown of 16%. And so I optimized this trading plan just as I did the non-leveraged group. Using the same routine as I did with our non-leveraged search, I found our best settings were with our profit locker stop on an end-of-day basis, trading our 5 stock portfolios, stepping in one at a time, again enforcing our industry diversification, and holding through the downs. We see that we had a 54% winning trade percentage, our percentage gain 66%. Comparing the 2 tests, we see that our finalized version has slightly lower percentage winners at 54%, overall gain at 66%, but our trade activity almost cut in half. Still maintained a 30% annualized rate of return, and most importantly, improved our drawdown from 16% to 14%, still almost 5 points higher than our non-leveraged counterpart. And so in conclusion, if you're just getting started or trading a small account, ETFs can be a great way to go, and with the VectorVest tools, your success will come that much easier. Thanks for watching.